The S&P 500 has led risk appetite to a charged start to the month of August, but seasonal norms don't usually point to such remarkable gains through this period. I'm John Kicklighter, Senior Strategist and Global Head of Content for StoneX, here to discuss the historical averages in performance, activity, and participation, particularly for this benchmark of sentiment. Now, risk on, risk off can be projected through a number of vehicles, but it can also be a ambiguous, big picture, holistic look at the market. But for ease sake, I like to look at something like the S&P 500, which is arguably one of the most heavily traded instruments around the world through its derivatives and through its indicative markets. Now, looking at that S&P 500 to just start off the first 2 days of August, it's already gained 3.3%. That's the biggest two-day gain that we've seen from this index since April 1st. And if you look at the charge with which it's in, over a 4-day run, you're looking at a 5.8% rally, which is the biggest we've seen since April 25th, 2025. And that is obviously back during the recovery period post the reversal of tariffs that we had during that year. Now, typically, we are heading into what is considered the summer doldrums. This is a time in which the markets usually get quiet, and there is a positive inclination of an expectation for markets to kind of just drift higher, but to really see a pullback in both participation, but also volatility. But as the saying goes, this time can always be different. And in fact, when we look back over the historical norms, we can see that things can be different. But on average, the S&P 500 through August is virtually unchanged. If I look back over 40 years or 75 years, both of those numbers I have looked back over, but we have seen less than a percent change on average for both of those periods. But if, let's say, that you have a range of very strong Augusts and very weak Augusts, that average can still be neutralized or norm around zero, but you can have outliers. So looking back over this history of August, where have we seen outliers? Well, there's a bunch of outliers that we have on both the positive and the negative side. If we look back over the past 4 or so decades, I would say on the certain positive side, we have periods like 2020, which is the post-pandemic recovery. You have 2000, which was among the dot-com boom, or 1986, when you had an exceptionally low interest rate and all the macroeconomic alignment was there for an incredible run through the month of August. But then on the opposite end of the spectrum, we would also have periods like 2015, which was a period that we were seeing yuan devaluation, which had a risk-off inclination across the broader markets. You had 2001, post dot-com bust, and then you also had the 1998 massive decline through the month of August, which was associated to the Russia or Asia financial crisis. So there are examples, but they are spaced out. Now, normally, this would tell us that we don't just look for activity to just come naturally. That's because most of those years, the month of August, was relatively sanguine, a modest move through that particular month. And we would also see it in terms of volume. So averaged out, actually, over the past 75 years, we can see that the month of August is historically the lowest volume month. Now, this is less prone to skews like we would see in terms of performance, because participation is more normalized. And through the month of August, we do expect lower participation. So you do need those exogenous influences, those big themes and drivers to actually knock you out of this quiet. So what are the exogenous influences that we're looking at right now? Well, you can reference a number of them. There's quite a few, and some of them skew to the positive, some skew to the negative. Obviously, since we're starting off August very strong, the expectation is that we are bucking the trend with a bullish run. We would expect to see some of the positives in something like earnings or AI, for example. And earnings, obviously, is going to throttle down. We are already pretty much through the bulk of the earnings season, and we're just going into the tail end, maybe with Nvidia, for example, as the last vestige of possible sourcing of optimism, if it's going to be positive. But then we also have the influences associated to AI. Now, this is more of a a well of enthusiasm and interpretation. It doesn't really have the exact tangibles. It is more prone to risk on, risk off as the catalyst rather than the actual headlines themselves. On the opposite end of the spectrum, we have the uncertainties with the U.S. Iran military activities. We also have tariffs that are reviving, and there are plenty of other negative influences like monetary policy or the persistence of inflation. So these exogenous themes are not particularly reliable, and I don't see a really solid backdrop to really carry us through an exceptionally strong August for 2026, although, of course, this time can always be different. So we have to see something that is a driver to get us away from that normal drift. And you have to ask yourself, what will be that driver, and will it put us under power, or let us just kind of see the meandering performance that we typically expect during this year? Consider this as you monitor and engage the markets through August. And if you can't answer that question about what is driving the markets and is it really encouraging, perhaps it's better to wait on the sidelines and wait until you have a certain degree of conviction. Thanks for listening, and don't forget to like and subscribe for more financial market insights like these.